Paula from SwissBorg Ventures, and I'm here with the weekly blockchain brief. This week we're going to start as usual with the news of the week, but we have a special section for you. Since we saw so many questions about the Ethereum merge, we're going to be discussing it with our senior investment specialist, Marco Pognini. And as usual, we're going to be closing with a bit of his insights. Let's go right into it. As you probably already noticed, we like following new ETF launches because their size gives away the institutional appetite in the crypto space and additionally gives us an idea about the hot sectors. And here we have another asset management giant which is launching a crypto-related ETF, and this ETF will be focusing on Metaverse and will be available to European investors. This is Invesco's third crypto-related ETF, which is following two others that were launched previously for American investors specifically. The actively managed fund will invest in companies of all sizes across the US, Europe, and Asia, and it will be available for investors in 14 European countries. The other two ETFs that we mentioned earlier were in a partnership with Elwood Asset Management and Galaxy Digital respectively. They both had less than $10 million AUM combined, which is still a tiny fraction compared to the overall AUM of Invesco, which is in the mind-bending $1.4 trillion. They are blockchain-related ETFs launched every few weeks these days, but I wanted to highlight here that they're all based on equities, not tokens. And if you're interested to invest in such true traditional trading platforms, I curated a list for you here. Or if you prefer to hold the crypto directly but still have ETF-like exposure, I recommend you to check our thematics. Details are now available on the SwissBorg website, and you can sign up and wait for the launch. Next, we have someone who made an impressive amount of profit last year and is on track to finish this year in the green territory as well. This is Sam Bankman-Fried's FTX. FTX revenue exploded 1,000% to beyond $1 billion last year. The exchange took revenue from below $90 million in 2020 to more than $1 billion last year as the cryptocurrencies hit an all-time high. This year, FTX is expected to generate $1.1 billion in revenue. That was disclosed through a leaked investor's deck. However, coming back to the revenue part, the exchange is probably set to beat out its previous earnings despite the slump in crypto prices and the corresponding low trading volumes. In regards to the incredible revenue, FTX's CEO has been actively acquiring troubled companies through three entities to solidify its place in the business. Some of the latest are the fintech firm Liquid and the Commodities Future Trading Commission regulated derivatives platform LedgerX, through which FTX can possibly offer crypto derivatives to US residents. Talking about FTX, last week was announced that Alameda Research co-CEO Sam Trabucco is stepping down from his role. While this is not a result of some sort of turmoil, this is more of Sam's own decision to focus on other priorities at the moment. Next, we'll be talking about the Ethereum merge and what are the latest updates. As you remember, the merge was announced for the 15th to 16th of September, but let's see if that timeline will be able to be retained, as Ethereum developers announced that there was a bug that resulted in data loss in the latest release. Despite the developers were able to fix the bug after a day only, the community is still wondering if there will be further hiccups before and on the day of the merge itself, and if there might be potential delay. So today, since the merge is already approaching, instead of our traditional macro section, we will be talking in a bit more depth with our senior investment specialist Marco Pognini about the merge itself. Hello Marco, thank you so much for making the time. I'm sure that our viewers will be super excited to hear your insights about the Ethereum merge. So I want to go right ahead into it. Maybe we can start by clarifying a bit what will happen with the miners after the launch. And there were some talks I heard about, like some pools shifting to proof of stake, while some pools will be still in proof of work, and overall, like how this will affect the earnings. What is your overall opinion on it?
Hello, Paula, and hello, everyone who is hearing us. We're approaching this very interesting moment, right? With the Ethereum merge. There's many different things happening, very, very important and interesting at the same time. So first of all, I would say regarding the miners and what pools will be doing, it seems like there is a preventive pull off from the market recently. People are not yet sure if they have, what they will do from, given that they have all their whole infrastructure being based on mining, and then decided how to switch properly into a proof of stake, which is staking, and then it's completely different. Very, very simply, when you have proof of work, you need an infrastructure to actually do your IT infrastructure needs to actually do some work. That's why it's called proof of work. And that was also like a good way, to actually give out the metrics for how much value has something. Because if you actually do work to create that Ethereum, then you actually know how much is the minimum value that you are placing on that asset. Now switching into staking, it would be interesting for those actors, for those players to understand what to do next. Most of them, I would say, they will transition into staking because, well, the fundamental didn't change. Right? If you were doing this before, it's because you know that there was enough adoption and there was enough transaction for you to make it a profitable business. And at the same time, I think it comes at a very specific and interesting time in macroeconomics, right? Like the price of gas, price of electricity going up like crazy. And so how much more expensive it would be to keep having Ethereum on proof of work. And now switching to proof of stake, where basically just to compare the two things, it would be much more, instead of being computational intensive, it would be software that would be doing this. It would not be necessarily just the hardware. So it would be a consensus mechanism, which it would be based on more of the efficiency of each validator. It would be based on the amount of coins that would be staked. So completely different way and much more greener also means today much more profitable potentially, or let's say much less costly, which broaden the platform to many other people coming in. So I think in the macro sense, it was a weird coincidence, but the rising price of electricity and the transition of Ethereum is a good opportunity for miners to switch into staking.
Indeed, you mentioned already that will be a greener option. So what do you think, how would that, maybe let's talk about how that would impact the Ethereum emissions rate?
Yeah, this is where things become basically projection, right? Because you don't know what's going to happen. I mean, right now, we have the inflation rate that is going down, given London update, which was the latest update on Ethereum protocol, but emission is going down already. But given what the projection are, so many more players as miners or say stakers will be in place, that means that there will be a reduction in circulation. The circulating supply will be reduced, so because many people will stake, and then out of the new algorithm for the rewards for staking and the burned Ethereum will be more compared to the actual people buying Ethereum and creating more Ethereum. So that potentially will have a strong impact on Ethereum becoming almost deflationary by default. Although it most probably is going to be deflationary for a short amount of time or for a period of time. But it will be extremely interesting, the fact that for the first time now we have Ethereum, which is the most transacted used for layer 3. It will be very interesting to see how this let's say modulated emission rate will work out. It's not just a fixed one as it is on Bitcoin, right? Bitcoin, you know beforehand what the inflation rate of Bitcoin is. Any other currency, you know beforehand how much the inflation rate is, at least for a quarter. But in this case, it will be extremely dependent to the transaction and to the adoption rate, which is very, very interesting.
Indeed. I think that you briefly touched upon the comparison with Bitcoin, but I want to emphasize a bit more on that. So now shifting to that model, how both maybe prices would react, would the correlation be different between BTC and Ethereum, and maybe just general, comparison to the proof of work to proof of stake of both?
Yeah, I mean, I think, especially in the news stream, in the media, we hear this, crypto is a new asset class. This is not correct. Crypto is a new finance. It's a new finance space. It's a new financial space. But what is important to note is that instead, inside the crypto sphere, we have different asset class. And I think this Ethereum merging with Ethereum 2 into proof of work or stake, this is clearly one of the first separation. We're going to have the split. So we're going to finally have Bitcoin who will have the, let's say, single utility of being a reserve of value, because you have proof of work. So you can, as we said before, you can, measure exactly how much it costs to produce one Bitcoin, depending, of course, where your farm is. But, there is the variable cost, but the fixed price of what creating and mining one new Bitcoin is. And so you can associate a price with it. And that's also why Bitcoin, it's considered to be the most trustworthy, because actually do work for it. You can measure it with amount of real money. And that will stay, its own space. And given that it was the first coin, given that it is probably the only one who is truly decentralized, there is no Bitcoin CEO. Nobody speaks for Bitcoin. Bitcoin goes on its own. It will create a space for him. Will generate a new asset class for it. While Ethereum will be the blue chip. Ethereum will be that technology that you invest into. So it's that blue chip stocks that will generate returns, because, you have staking now, which you can see. I mean, there is nothing that you can compare into traditional finance, but it could be similar to dividends. But it's going to be that blue chip, because every innovation, given the rate of adoption, given the amount of transaction, given the amount of developers, in any metrics, Ethereum is dominating return over the protocols. So if you look at that, then Ethereum is going to be that, IBM in the 1960s, where it was dominating the tech world and the stocks. Yeah, that will be Ethereum, and it will be on proof of stake rather than proof of work. So it also, that ambiguity can be removed. So it will be completely new, different asset class, and moving into something comparable to a blue chip stock. That for me is the most positive, because it will bring clarity of what it is one thing and what it is not, and vice versa.
Wow, I see that you're very, very bullish on Ethereum. What do you guys think? Are you bullish on Ethereum? Write down in the comments. Great, Marco. So anything else that you have and you want to add about the merge? Any interesting information out there that you came across?
Yeah, so looking at some metrics, off-chain and on-chain data. So it seems like right now we have a decrease in on-chain transaction over Ethereum and on-chain trade, while we have a huge increase since already 1 month in off-chain data. So people are actually trading Ethereum, most probably for speculation, or because they want to get it for joining the validating pool later. But that's what's happening. And then in the derivative market, we see that people are placing protection. So they trade on the future, most probably, or they trade the spot, and then what they do, they buy option or short, so in order to protect themselves. And it's very interesting where the level is, because it's interesting that we see that there's a lot of traders that are actually buying rumors, sell the news type of activity, but there is a strong level of put option at a price of 5,000, which is very high price compared to where we are right now. So we should expect volatility the next month, but specifically going into those days of the merge. If everything is successful, then it could be potentially positive, but we should expect volatility at that time. I mean, the data is clearly indicate that.
Indeed, yeah. And actually the launch of the CME options on ETH are also around the 12th of September. So I'm really interested to see how that will work out in terms of volumes and strikes and open interest.
Yeah, the more participation, it seems counterintuitive, but actually the more institutional participation will come from the derivative markets rather than spot. And this spot exactly is where we have the most resistance. We see a great scale how much they're fighting, right? The SEC to actually get their fund approved over the spot for Bitcoin. So that's where things are. Money from institutional will come most probably and first only through derivatives markets. So where this will give us an idea of what the institutional feelings is going to be, and it's important to understand what that type of smart money will do. It's a very interesting and good indicator at this point.
Indeed, yeah. It will be interesting to do a brief at around that period, right before the merge and after the launch of the options. Yeah. These were all very valuable insights from Marco. We want to thank you so much for being with us here today.
Thank you very much. Thank you, Paula.